Chapter 13 is our last chapter on investing, this time focusing on mutual funds. As with all chapters, here are our learning objectives. Number 1, explain the characteristics of mutual fund investments. Number 2, classify mutual funds by investment objective. Number 3, evaluate mutual funds. And 4, describe how and why mutual funds are bought and sold. Basically, a mutual fund is an investment vehicle. It's created by an investment company. It pools the money from many investors. It buys stocks, bonds, ETFs, and other financial securities. All the buy and sell decisions are made by a fund manager. Fund investing began really in the 1700s in Europe, but gained popularity in the United States before the Depression. Mutual funds are very frequently part of a 401k, IRA, or a 403b retirement account. As of 2017, over 96 million people in the United States owned mutual funds, many of those in their retirement accounts. The number of funds has ballooned over the years, reaching over 19,000 in 2016. Clearly, mutual funds are a very popular investment vehicle for American investors. The two main reasons investors choose mutual funds are professional management and diversification. We already know about the benefits of diversification, not putting all your eggs in one basket. With a mutual fund, the diversification risk reduction is taken care of for you, and it's handled by a professional money manager who makes all the buying and selling decisions, relieving the investor of that work as well. Speaking to the diversification, this Exhibit 13.1 on page 423 shows the allocation of investments in the Invesco Income and Dividend Fund. Notice that Invesco has spread its investments over a wide variety of industries, with even the highest percentage less than 9% of the total portfolio. Closed-end funds make up less than 2% of the fund industry. A limited number of shares are issued when the fund is created. After they're issued, the shares trade on the open market like a stock. These are actively managed funds where the assets held change, but the number of shares does not. Exchange-traded funds, or ETFs, are a relatively new and fast-growing segment of the mutual fund industry. ETFs are designed to match the results of a specific index. Very low management, since they only change when the index being matched changes. ETFs trade all during the day like stocks on exchanges. There's no minimum investment amount, and they can be sold short, and you can use limit orders to trade them. Open-end funds are by far the most popular type of funds. All shares are issued and redeemed by the fund company on demand. Fund shares only trade at the close of trading each day. Open-end funds may be actively managed or match an index. Open-end funds trade at a price determined by their net asset value, which is determined each day at the close of trading. NAV, the fund's net assets, assets minus liabilities, divided by the shares outstanding. Open-end funds trade at their net asset value. Closed-end funds trade at a discount from their net asset value. Load funds are those which charge a commission. Loads average from 3 to 5%, but can run as high as 8.5%. Loads come in three types. A class is a front-end load. An investor is charged a fee when they purchase the shares. A B class is a back-end load, or a contingent deferred sales charge. The investor is charged when they sell shares. A C class is a level load. It has no sales load but higher 12b1 fees. Load funds are purchased through brokers or registered representatives who are prepared to explain the fund's objectives and help determine if it fits your needs. No-load funds charge no fees, inbound or outbound. There are no salespeople. All shares are purchased directly from the investment company. Mutual funds do have fees other than sales charges. Management fees are what you pay to have that professional management, and they can average 0.25 to 1.5% per year. 12b1 fees are basically marketing charges. 12b1 fees are named for the SEC regulation that permits them. They're charged to offset sales and distribution expenses. Note that 12b1 fees cannot exceed 0.25% for a fund to be called a no-load fund. Each fund publishes their expense ratio, which is the total all investors pay for a fund's management and operating expenses. This tells you a lot about what investing in the fund will cost. Exhibit 13.3 on page 429 recaps the description and typical fee ranges for the various fees mutual funds may use. Looking at long-term mutual funds, they can be divided into three classifications: stock funds, bond funds, and other funds. Stock funds can be subdivided into a variety of choices to suit virtually all needs. Funds that focus on price appreciation or income growth, those that are categorized by firm size, large cap, mid cap, small cap, domestic versus international funds, U.S. versus global or Pacific Rim, index funds that match a chosen index like the Dow, sector funds that invest in specific sectors of the economy, healthcare, technology, socially responsible funds that avoid stocks related to tobacco, nuclear energy, weapons, gambling, or alcohol. Bottom line, there's a fund to basically meet all your needs. A variety of bond funds exist as well. High yield invest in junk or high yield bonds and are high risk. Short-term, intermediate term, and long-term corporate bonds. Short-term, intermediate, and long-term government bonds. World bond funds, including debt securities from foreign corporations and governments. The other fund category covers basically everything else. Asset allocation funds are aimed at investing in a mix of assets to achieve a high return. Balanced funds invest in both stocks and bonds with a goal of protecting principal and generating income. A fund of funds invests in other mutual funds, increasing diversification, but also increasing the fees charged. Life cycle funds are aimed at those planning retirement at a specific date and reducing the riskiness of the assets as that date approaches. Money market funds invest only in short-term, safe, highly liquid CDs and government securities. A family of funds is when one investment company manages a group of mutual funds. Think Fidelity. Each fund has its own objectives and manager. The main benefit to investors is that shareholders can easily switch between funds within the family. These are very frequently the choice for a company's 401k plan, as it gives their employees a wide variety of options and a control of their investments. Portfolio construction in this sense is nothing more than diversification using mutual funds rather than individual assets. And as we know, diversification can reduce risk. Using the same logic, choices about which stock, bond, or other mutual funds to include in your portfolio is based on your personal risk tolerance and investment horizon, and this can reduce risk while increasing returns. This slide outlines 3 basic issues to consider when making the decision to include a mutual fund in your retirement account. The beauty of a mutual fund is the professional management without your participation. If you want to be actively involved in the management of your portfolio, then a mutual fund may not be for you. And don't forget the stage of life rule of thumb. As you age, more of your portfolio should be in less risky assets. More bonds, less stocks. This same applies to stock and bond funds. The choice between an actively managed fund and an index fund may come down to how specific you want to be in your investment choices. If you want a sector fund or socially responsible fund, then you may want a professional manager making the buy and sell decisions. If you believe a specific money manager with a great reputation is worth the higher fees, then a managed fund may be a good choice. For many years, Peter Lynch, the manager of Fidelity Magellan, was that type of fund manager. If you want to more or less follow the market, an index fund may be the best place for you. You can be a bit more selective and choose a sector or global index, for example. The plus of an index fund will be lower management fees and lower turnover in the fund. Information on mutual funds is widely available online and from professional advisory services for a fee. Yahoo is a readily available source for all financial data. The leading mutual fund advisory service is Morningstar, and the Wall Street Journal periodically runs full sections on mutual fund performance. A mutual fund must provide a prospectus to potential investors. The prospectus will include the fund's objectives, growth, income, a clear description of the risk factors involved, a recap of the fund's past performance over the 1-year, 3-year, 5-year, 10-year, and 20-year time frames, the types of investments in the fund's portfolio, information about dividends, distributions, and taxes, a profile of the fund's management, any limitations such as minimum investments, fees, and withdrawal options, how shares are bought and sold, other services available to investors, the fund's turnover ratio, meaning how much the fund trades during a year, higher turnover, higher expenses. As with a stock, a mutual fund must also provide investors with an annual report. The annual report will contain detailed information about the firm's assets and liabilities, performance, and their schedule of investments. This is the only time a fund is required to disclose its holdings. This is your opportunity to determine if the fund's holdings match their stated objectives. The same financial publications that cover stock also cover mutual funds. Mutual funds can be categorized by investment objective, as we've covered. They can also be described by size, referred to as AUM, assets under management. Load and no-load funds may be listed separately, and funds are ranked on performance. One of the big advantages of investing in a mutual fund for an individual investor is the low minimum. You can open an account in some for as little as $250, which will get you started on investing in the market, though indirectly. We discussed that stocks and bonds offer two ways of earning returns, cash and capital gains. Mutual funds offer the same two sources. Dividends on the stocks in the fund. They're taxed as ordinary income. Capital gains or losses when you sell your shares. These could be taxed as short-term or long-term gains depending on how long you've held your shares. Mutual funds also pay out capital gains distributions, which are your share of the gains or losses when the fund buys and sells shares. These are taxed to you as long-term gains. This table recaps the three sources of income we just discussed. So how do you buy a share in a mutual fund? For closed-end and ETFs, you buy them just like shares of stock. With open-end funds, it depends on whether it's a load or a no-load. Load funds are bought through an authorized agent. Remember, they're prepared to fully explain the objectives of the fund and discuss whether it fits your needs. No-load funds are bought directly from the company managing the fund. With open-end funds, there are several ways to invest. Regular transactions, just buy shares when you want to. Voluntary plans, you can set up a recurring purchase plan. Contractual plans, basically plans that specify the number or amount of purchases to be made over a certain time. And reinvestment plans, much like DRIPs, dividends and distributions from the fund are automatically reinvested in the fund shares. What about when you want to withdraw money from the fund? With closed-end and ETFs, you just sell your shares in the market, the same as you would with stock. With open-end funds, the shares are sold back to or redeemed by the investment management company. As the slide states, most funds have several withdrawal options. They're usually linked to having a certain amount of funds invested, typically about $5,000. The choices include withdraw a specific amount each period until the account reaches a zero balance, sell off a specified number of shares each period, withdraw a fixed percentage of growth leaving your principal untouched, or withdraw all growth from both dividends and capital gains, leaving the principal untouched. This completes Chapter 13. We'll review the learning objectives for this chapter. We started with learning about the characteristics of mutual funds. Continuing learning about mutual funds. Classifying stock funds by their investment objective. Classifying bond funds by investment objective. Classifying other types of mutual funds and describing a family of funds. Evaluating mutual funds. Sources for information on the performance of mutual funds. How mutual funds are bought and sold. How mutual funds earn returns.